This is Mark Pilkington, author of Retail Therapy, Why the Retail Industry is Broken and What Can Be Done to Fix It. This is my weekly insight into all matters brand and retail, what's happening, why it's happening, and how can you profit from it. As readers of my book or blogs will know, I'm convinced that the traditional model of retailing, with its expensive brands, its large stores which are really glorified warehouses full of stock that nobody's sure anyone's going to want, and its low levels of customer service, is on a slippery slope. And if we look at this week's news from Brands and Retail, we can see that this is in the right direction. Starting in the UK, Debenhams is in deep trouble, with a profit warning based around same-store sales down 3.5% in the half year to March 2019. And as if this was not enough, its e-commerce sales were only up by 2%, which is very surprising given that it bought in CEO Sergio Boucher from Amazon specifically to boost this area. With its shares at 3p, can it be long before it goes under? And after that, the most likely next step is into the tender hands of Mike Ashley to squeeze the last drops of cash out of what was once a great business. Ashley has already launched a motion to fire the board. Turning to the fashion market, we can see more carnage everywhere we look. LK Bennett has fallen into insolvency with a CVA, a company voluntary arrangement. Ted Baker, already marred in a scandal relating to the hugging activities of its charismatic founder Ray Kelvin, has issued a £10 million profit warning. Superdry has announced a headquarters restructuring with a loss of 200 jobs on the back of half-year profits dropping 49% in its December interim report. And finally, Quiz, the fashion group with 250 stores and concessions, has seen its share price halve on the back of sales down 11% in the first 2 months of the year. Fashion is not the only area that's been affected. Other sectors have also seen considerable damage. Paperchase, for example, has declared a CVA after losses of 6.3 million last year and the closure of 5 stores out of 145, with 23 more at risk. Restaurants continue to be affected by the loss of high street foot traffic, with Boparan Group, owner of Giraffe and Ed's Easy Diner, declaring a CVA with the closure of 27 stores out of 87. Now, another area that's been suffering that people don't think of as part of retail, but in fact it is the estate agency sector. Foxtons has declared a pre-tax loss of 17.2 million in 2018 versus a profit of 6.5 million the previous year. And Countrywide, the largest UK group, which owns brands like Hamptons and John D. Wood, has reported losses of 218 million in 2018, following on from a 207 million pound loss in 2017. Now, I know not everyone's going to grieve at the thought of estate agents suffering, but I think maybe we should be sympathetic. After all, they are retailers too. Turning to the American market, US retailing continues to present a more mixed picture. Companies like Walmart, which have invested heavily in online, as recommended in my book, have done well, while others are suffering. Over 4,300 store closures have been announced in the first 2 months of 2019 alone, which is far worse than last year. Victoria's Secrets continues to flounder, with same-store sales down 3% in the latest period, and the announcement of 53 store closures in 2019. In my view, what is happening to VS is emblematic of the way many traditional brands are out of step with the new zeitgeist. Hedge fund Barrington Capital has correctly called out Limited Brands chairman Les Wexner as being one of the causes of the problem of Victoria's Secrets. Wexner has outspokenly stuck with the brand's 1990s very sexy positioning in the face of the Me Too movement, and with physical stores in the face of the online boom. With him at the helm, it's really difficult to see the retailer turning around anytime soon. JCPenney is closing another 27 stores in 2019, on net sales down 7% last year, while Macy's is to cut 100 million in costs as it saw its Q4 profits nearly halve from 1.35 billion to 0.7 billion. And Abercrombie & Fitch announced the closure of up to 40 stores in 2019, on top of the 29 that it shut in 2018. Dollar Tree took a $2.3 billion write-down in Q4 and is to close 390 Family Dollar stores. Gap, most shockingly, has announced its breakup with the relatively more successful low-priced Old Navy being cut free of the failing Gap and Banana Republic brands, amidst plans to shutter 230 Gap stores over the next 2 years. On the brand side, heavily indebted Revlon's share price dropped 18% on the announcement that its sales were down 9% in the last 12 months and a whopping 15% in the 4 weeks ended February 23rd. Now, all of these figures are all the more alarming given that the economic growth in the US is nearly 4% last year. Retailers and brands should be making out like bandits, and the fact that they're not really says something sinister about the underlying retail crisis. Meanwhile, online companies continue to do very well. Etsy, the artisanal marketplace, announced stellar Q4 results with both revenue and EBITDA up 47%. Yoox Net-a-Porter, which is part of the Richemont Group, saw sales grow by double digits in the quarter ending December 2018. Wayfair, the online furniture company, enjoyed more than 45% growth in net revenue last year. And in other markets, China's Alibaba reported net income up 37% in the December quarter, on the back of revenue up 41%. While Zalando, the leading European fashion website based in Germany, reported sales up 25% in Q4. And online direct-to-consumer brands are continuing to open what I call lean stores. Brands like Warby Parker, Casper, Allbirds and Everlane are planning to open hundreds of stores. Their vision for stores is, however, very different from that of traditional retailers. They see them as more showrooms, designed as brand recruitment points for their online businesses, rather than the glorified stock warehouses of the traditional players. Leading US mall group Macerich is backing this trend by launching a new concept called Brandbox that enables digital brands to experiment with stores on a low-risk rotating basis. Tying in with this trend, a new venture capital fund called Fifth Wall is explicitly backing digital brands that want to move into retailing. So that's about it for this week's roundup. So far, so scary for traditional brands and retailers. If you are a brand or retailer and you want help bulletproofing your business against the retail apocalypse, I have structured programs that can help you do a number of things. They can help you build a strong online business fast. They can help you reimagine your stores to reduce cost and increase impact. They can help you get some real innovation into your product development process and also help you move your brand strategy on to appeal to millennials and Generation Z. Lastly, and most importantly, I can show you how to change your culture in order to enable you to compete with the fast-moving .coms. Please call me on +44 7895 012288. And if you're an investor and would like help picking which consumer and retail stocks are going to tank and which ones can unlock hidden value, then you can also contact me. I'm available on mark@markpilkington.net. Take action now before the apocalypse arrives on your doorstep.